All right. Good morning, everybody. So we got JOLTS data today. It's an economic data point that basically looks at how comfortable somebody is with the idea of quitting their job because they think they can get a job somewhere else. In tight labor conditions, you keep the job you have because you're really worried that if you lose it, you won't find one somewhere else. JOLTS is often called the take this job and shove it economic data point. It's easy to remember when you think of it that way. This entire week is going to be filled with different job data points, but the big one will be non-farm payrolls, NFP. So as you can see, we got a lot of Fed speakers from around the world, European Central Bank, Bank of England, and the US with Cook, Collins, and Miser. I did manage to find the spot gamma levels. They just happen to be in a different location. So yeah, you can grab your screenshot of the levels for today. They had a really nice write-up. I'm going to parse through it a little bit later. Basically, they said the S&P is likely to continue to grind in a range-bound market or a difficult chop higher, while the NASDAQ and individual names could outperform. In a nutshell, I'll clean that up a little bit later, but that's basically what they said. All right, so looking at Hong Kong, China, they kind of stumbled a little bit, stalled out. After this 2-day run, really nice recovery, closed inside day. And really, it's IX10 from this really big candle back here from the 6th. So nice recovery off the lows if we're looking at it on a daily. They had an inside day breakout to the downside, managed to rally back up inside the box, but that's all they got, right? So they're still range bound from March 30. Just kind of holding the low after this reasonably decent recovery. So a dud day for them. Japan, remember yesterday we had economic data that I mentioned we could see the outcome of today. Well, I mean, they gapped up really nice, came back down, closed the gap, and then bullish Romney closed all the way at the top of the day, inside day breakout, but not by much. And if you look at the muted nature of this candle, right, like how small it is, and the others at how small they are after this breakout from this really big day on Wednesday, March 29. Then we had the inside day here. Nice breakout and follow through. So this is your Haramni, and that's a bullish Marbozu. I misspoke. Right? No wick across the top. And for Europe, which is only 1230, 1240 right now, it looks like the 5-bar rule won't even get applied here, but they were running out of room before a red day. Had an inside day breakout, gave it back, sitting at the low of the day. As long as they remain range bound inside of yesterday, April the 3rd, it's not bearish. It's just a pause, right? So a little something to consider. Finance Juice does a really good job of kind of laying out what happened in the European session. Well, in all sessions, really, if you scroll back far enough, you can read what happened in Asia, and then you can read what happened in Europe. And after our trading day, you can read what happened in our trading day. So they do a really good job. Oftentimes, it's worth looking back and seeing what moved the markets in Europe or in Asia first and then Europe to see if there could be some contagion or carryover into our market. We don't always get that, right? But sometimes we do. So it's worth taking a look, just kind of scrolling back, seeing what the news was through the Asian session and into the European session. And then just remember that the markets are still open in Europe, right? They're not closed yet. So we can continue to get news out of them, even while we start getting news from here too. It can completely change your outlook on the day, right? And that's kind of the whole idea of the morning briefing, not me giving you a fish, but you figuring out how to fish for yourself. And with that comes, how to parse out this data. So they're still going on about the OPEC situation. We had Yellen out yesterday chipping teeth, but she didn't really get very far. We want to listen for a consistent message out of the Fed. We got 3 speakers today, and we want to hear them singing out of the same hymn book, right? We don't want them deviating and offering their own opinions. We're looking for the Fed's message here, right? So a common thread or a common theme between all of these speakers, the European and Bank of England speakers, set that aside. We're talking about for the US speakers. We want to hear all of them say the same thing. They're going to try to find their own way of saying it, right? They don't want to just sound like a puppet. But the gist of the conversation should be the same through each one of them. So here we can see that Cook is running a pre-recorded remark. So that's nothing, right? There's no chance there for a screw up, to say something out of line, or to drop a spoiler alert. So the 1:30 Fed speaker, that's nothing. We can just ignore that one at this point because it's just some pre-recorded junk. The other one at 1:45, unless he's actually going to do some kind of Q&A afterwards, the topic of his discussion here has no impact on the markets either. So we can ignore this one as well, unless, like I said, they start asking him questions. Because whenever they start asking a Fed official questions, there's the potential for them to screw up. And I have felt the pain of ignoring a Fed event where a non-voting member of the Fed was asked a question and his off-the-cuff remark dropped the market. So it happens, right? And that's all it takes, is for one of them to get a little gib in the mouth, chip some teeth, say something that can put the market in one direction or another, even though they didn't intend to do that. We got the dollar still maintaining right around that 102 level. And as long as we're holding above 100, everything's fine. But we're going to see a dynamic shift in market structure if the dollar gets below 100. All right, so all this weakness is fine, especially from the idea that this is a classic double bottom. Looks like a bear trap extraordinary, and it's just going to pop right back up again. That's what it looks like. So as long as it still looks like it has some structure here, nobody's too concerned. If we actually break structure and start heading down to 101, we'll start to see a little concern. We break 101, yeah, that'll be a game changer. So something to kind of keep your eye on. Weakness, flat, okay, not too big of a deal, and holding this double bottom low. You know, everything's fine. It's okay. Factory orders, JOLTS, and then an additional auction at 11 o'clock. The afternoon is pretty much clear. As you can see, those Fed speakers aren't really a big deal today. So for your 0-day trades, you're good to go after lunch. The volume is coming in just a little light, but it's fine. Nothing that really stands out as extreme. So it's just mildly light, and it very likely has something to do with JOLTS. I wouldn't read too much into, you know, the lower volume this morning, because it really is just a negligible amount, right? Yesterday was 102 and today we're at 95. There's not much window, you know, not much shade between those two. If we were below 80 or maybe 75, I would be more interested in what's going on with the economic outlook this morning, but we're not there. So we just get it out of the way. We have yet again another MDP. Count how many in a row here. From Wednesday, Thursday, Friday. That's 3 days. 4 days. We're on day number 5 of an MDP. MDP is a missed daily pivot. It's not my strategy. I don't trade it, but I certainly use it for a part of my analysis, kind of a bigger picture point of view. I probably talk about it more than I should, considering I don't trade it. But if you want to learn more about it, just go to YouTube and type in missed daily pivots. You'll come across it, right? And you get the Knoxville indicator and I don't know, a couple other little widgets. It has some merit behind it, some bearing to it. Just from the idea that it's easy to see. You can use it on multiple time frames, you know, daily, weekly, monthly, intraday, like I am, whatever, all over the place. When I got up yesterday morning and they said that we were slightly down, that made me bullish on the week, or at least on the day. When I got up this morning and I found out we were up, this is phase 2, so I expect it to still go up. We're not really gapped that bad, just a little push through the kill zone. Okay, maybe not even the kill zone. It came after the kill zone. So inside day breakout, a little bit of a push, nothing too much yet. But we're looking for that blow off top morning, right? That overly extreme up 1%, mega rally, everybody crazy bullish. That's the short day. This doesn't feel like the short day, not yet. So a little up in the pre-market. Notice the really tight range here. We call this the initial balance. Think of the initial balance as a fancy open range. The difference though, if it's during the regular trading day, say the market opens at 9:30 and you have a 5-minute open range or a 15 or a 30 or 1 hour, you get to choose. But when it comes to the IB, you don't get to choose. It's always 1 hour. So with the 1 hour IB, you mark out your open range. And then that kind of sets the tone for the Globex session. One way to look at it is if we haven't really gone anywhere all night long and we maintain inside this very narrow IB, that everybody who has work to do hasn't done it yet. Whether they, have a lot of sell orders that they need to take care of or a lot of buy orders that they need to take care of, they haven't done it. You can see at some point this morning, they finally started getting some work done. The very narrow range implies that at any point during the day, we could start to see this big move begin to unfold, because now they're going to get in there and start getting their work done. If the big move had already happened, we would approach it from a different point of view, from the idea that they've already got their work done, and we may not expect to see the move continue much more at that point. It's perhaps a different take than maybe what you're used to, right? And that's not necessarily my point of view. There's a lot of books, webinars, that kind of go into the initial balance. So something to consider. We are inside day breakout. For anybody who's still confused on that concept, this is yesterday's trading day. We opened inside of that trading day, and then we rallied out of it. So it's exactly like it sounds. Inside day breakout. You can use that concept with inside candle breakout on just about anything. So if you're looking at, say, a 1 hour candle, mark your high, open, high, low, close, drop down into a 5 minute, trade a 5 minute breakout of a 1 hour candle, right? That works. Just about anything works. Really nice head and shoulders here on the 5 minute. Didn't see it on the 15. Boy, that's textbook classic. Very beautiful. Oh, ain't it pretty? Yeah. $41.60 is first target. That gets you close to VWAP. A VWAP break, 41.57, would also get you back inside of yesterday's range. It wouldn't surprise me if we come down and test the breakout, right? That would give us a Busby. It would also be our measured move. We could overshoot a little bit. So coming down into like 41.55, maybe 41.56, flip around and then head back up again. But we have set our high for the morning and we've pulled off of it quite a bit, which sets us up for this really nice trade at the open. We don't always get it, but when we've set a high in the Globex, this one's really a bad example. They're too close together. But when we set a high in the Globex and we pull back off of that high, kind of chop around, we get closer to the open, we rally up in the RTH, retest that Globex high, and then kind of chop around from there, or we get our breakout. So we've got our high for the Globex. Unless Econ comes in and takes this high out, which, I mean, it could. Otherwise, this high is the going to be the focus of my morning when it comes to the trades. Either trading it back up to it and or a rejection off of it. $10-day, 30-minute volume profile. You can see the expansion behind or beyond the VAH to value area high. I rarely talk about the value area high and low, especially on this chart, because I have it set to a really wide, you see almost at 100%. And it's generally, if we're using the profile with a 1 standard deviation of volume, then we can see the box right now is just this lower area. So 70% of all of the volume is down here. So we can see a strong volume shelf around 41.40. This is a level that's kind of popped up more lately. Spot gamma kind of brought it in, and then it just kind of like a house guest that won't leave. So it's a part of the space now that it wasn't there 2 months ago. It is now. So 4140 has a lot of time on it and a lot of volume on it. It could provide a little bit of assistance should we begin to fade back down. Keep your eye on Friday's close and Sunday's open. Those will be levels, if we do revisit this, that almost line up with the high and low of that volume. If we break through, say, the Globex low of Sunday night, Monday, it's an air pocket. We should drop through this shallow zone really fast, just like we ran up through it really fast. There's nothing really there to slow us down or interfere with the move. So should we break below 4120, we should easily be able to get to 4080 without much hesitation. Otherwise, for an upside move to continue, there's nothing up there, nothing in the way to slow us down. I had mentioned it the other day that we were going to lose the lower part of all that volume that was down here, and we did. It's gone. So now this will maintain as our low for at least a week, unless we go down there and take it out. And on that note, when we're at the low, we expect to go to the high. And when we're at the high, we expect to go to the low. Well, we're at the high. We're not just at the high, we're making new highs. So we're expanding this 10-day indicator right now to, we're widening it out quite a bit. Five-day, 5-minute volume profile, call it mapping out the 5x5. We now yet again have another VPOC underneath us. So the POC is the point of control. It's the spot with the most amount of volume yesterday. Once the day is done, we project that POC forward. And as you can see down here, we've projected all of these lines forward. And we keep that line there. We keep that projection going day after day after day, unless or until price comes down and interferes or interacts with that line. Because at the moment, it's untouched. It's a virgin point of control. And I don't name this stuff. So, that's just what it's called. I ain't come up with it. So a VPOC is just a point of control that hasn't been hit yet since we've started carrying it forward into a new day. You can see on last Thursday, the VPOC didn't even get a chance, right? If you were to ignore this, which, it's on you, it still got hit back here. So we wouldn't carry that forward past that location because it was hit already. And I would argue it never had a chance anyways, because basically as soon as it opened, gapped down right into the VPOC. So there was no chance for that one. We've got a lot of them now underneath us. We still have one overhead at 42.30. I still think that one's a little bit out of reach at the moment. There's still a lot of bullish market breadth out there. It's really hard to ignore. And until we get some change in data points, that bullishness is just going to keep on going. And the one data point that continues to stand out as a negative is the earnings. Forward earnings are just completely out of sync. And we've got, a new earnings season kicking off next week. By the way, speaking of earnings season and everything, Friday, the market's closed and we're getting non-farm payroll on Friday. So really think about what the market's going to do with that data on Monday or even on Sunday night when we open. So for this week, our range, let's get on the right symbol here. 40.62 to 42.16. It's not a bad zone. Not really all that big. We're getting a continuation advance. See how far away we are from this thing. 1.3%, give or take, maybe 1.25. We're not that far away from the edge of the weekly expected move. We could hit that in a day, no problem. But that would also be day 5 or candle 5, right? The 5-bar rule. So, you got to have a little bit of an expectation that we're going to pause after today. One of the reasons for that argument is if we do get to the edge of the box today, or even near the edge, and then we close it and we open back up in Globex, and then we rally the rest of the way, get out of the box, maybe extend beyond it a little bit, and then we fade and come back inside the box. Because we're going to close inside this box at least 80% of the time on the week, right? On a Friday close, we're going to be inside this box 80% of the time. So it would make sense if we see a rally just like here, and I know this is a little messy. This was a week. So we opened on Monday, had a nice rally into Tuesday. Tuesday closed, we got into Wednesday, rallied out of the box. It came right back in again. So I'm looking for that last hurrah, that really big wick day before the flip. I don't think it's today. I think that's tomorrow. So today's just going to be a continuation still. That's my baseline bet. We're 2% away from the 10-day moving average. We're not exactly overbought, but we're getting there. We're getting into that spot where the market is ready to take a break. It'll either pause and let that 10 get caught up with it, or it'll flip around and come back in and kind of help the 10 out a little bit, one or the other. So we're not at the extreme levels. You can see we've been higher than where we are right now. But we're near the point where we top out. $41.80 is the measured move that I have from this weekly candle here. So I basically measured last week's candle, plotted the 50% for the line in the sand that we should not fade below, and then projected that with Fibonacci to the upside. 41.80 is the number we get. Now we could add the warning center to that, the 111. Maybe see how the market reacted to that warning center yesterday. It didn't. It missed it just by a little bit. It failed to get to that 111, which is one of the reasons I keep the 111 on there. A failure to get to it, a failure to get through it, very often tells us that we're going to need a reset and a rerun to get at it, right? Which we did. Consolidated. Grimes talked about this in his book, where we have a resistance level and then we build up underneath it. It's a pre-breakout buildup. Pretty interesting. He wrote a book, The Art and Science of Technical Analysis. It's free. You can just look on Google and find the free PDF kind of floating around out there. If not, just hit me up. I've got a copy of it and send it to you. It's a good read. And it's free. Free. All right, so we got the China constituents down this morning, those China ADRs that we identify through KWeb. They're down 1%, which is a little more than I would have anticipated for the weakness that I would have expected to see in there, but is fine. Bonds are also down 0.5%. A little surprised with that. The Qs are up, Bitcoin is up, energy is up, and the rest are basically flat. Bitcoin also not up enough to hit my metrics or my level. So depending on which Bitcoin we're using, the BITO is like more of an ETF. And if you use, where'd that go? GBTC right there. Then it's a more accurate proxy, I guess would be a way to say it. The BITO is a basket of stocks, and this is just one single thing. Looks like we got a breakout in gold starting. Nah. The indicator might be a little soggy. Still reading yesterday. %17% of the S&P is up this morning, 0.5%. It's not overly inspiring. And some of it's a continuation from yesterday with the EV fail that we saw in Tesla and NIO with their delivery issues. And now we're seeing a little bit of that in the other direction, like a whiplash, a little bit of rebound in the other direction. It's mean reverting, right? Like linear regression and dot plot statistics, that kind of thing. It's just coming back to the mean. I wouldn't bull up on them for any length of time, certainly. And then we also have some FANG names this morning: Microsoft, Meta, Amazon. They stand out in the crowd. Also, AMD got added to the NY FANG list. Right, I'm still kind of wrapping my head around that, but Snow and AMD are on the NY FANG index now. So they're not, quote, one of the FANGs that we would generally think of as a large market cap name like Microsoft, Meta, Amazon, Tesla. But it is on the NY FANG list. So kind of chew on that one, huh? On Thinkorswim, you can make your own indexes, which is really kind of cool. That way you can see the NY Fang in the pre-market, which you can't do if you're using the NY Fang index symbol because it doesn't work in the pre-market. And then you can use some simple little math to kind of weigh each of those names. Yeah, I might make a video on it. All right, so we can see AMD here. It's a tiny little box in relation to its real FANG peers, Apple, Microsoft, Google, Meta. All right, they're all these really big boxes. The boxes are kind of representing their market cap. And it's just a little bitty baby compared to all those. But they're all looking really good this morning. From Amazon, Tesla, across the board, NVIDIA. The financials kick off earnings next week. Next Friday, I believe, is the official first day. I could be wrong. It could be Thursday. Either way, it's next week. And then energy's looking really good. But so this screen isn't right. I think Visa got classification change. It's no longer commercial services. I think it's actually finance now. And it's not the only one. There's one more. It might be MasterCard. I don't want to say for sure. What really stands out, healthcare, flat, and producer manufacturing, transportation, those boring defensive stocks, flat to down. So it's all the money's flowing into the risk on sectors and everything is looking, yeah, pretty bullish from a sector perspective. %21 of the NASDAQ is up at least 0.5% this morning. Semiconductors really big on that list. It is the list for the NASDAQ. Sure, there's a couple other names in there, mostly FANG names once we get outside of those semiconductors. So that really says a lot. All right, so here on Tesla, we can see the orange line here is how far it's come up off of that bottom since the close yesterday. It closed on my monthly line, and then it rallied up here in the pre-market. We're not even halfway through this candle yet, and we need to get above that 50% mark if we're going to believe that there's any real recovery to this thing at all. Otherwise, it's just a little bit of a up move. Consider this a bounce off of support with a rally into resistance, and that it's very likely going to just roll over and continue to move back down towards this 188 area. We still have a gap to close at 183, but obviously not today. So they had news yesterday. It's a part of this punch down that it took. Overproduction and I don't know. I didn't dig through all the news. I just know it wasn't good news. But if we come out to the weekly, this still looks relatively bullish off of this move on that 166 with the run back up. There's a lot of unfinished business up here. So for today, we want to put a benchmark line in the sand around 50% of yesterday's candle, which would be 202.43. It's not even yesterday's candle. It's Friday's candle. Let's move over here. There we go. That makes more sense. 197.38. We need to get at least above that. If we happen to get there in the pre-market, we want to use that level for a support or a line in the sand that it shouldn't come back down below. If we don't get there in the pre-market and we open underneath it, look for a rally through it or above it. So when we see that it's up this morning, don't put Tesla in the same basket of everything else this morning. Right? Even though it's a FANG name and the FANGs are up, don't lump it in there with the rest of them because it's got its own thing going on, right? With the news and you know, the reaction that it got yesterday. So Microsoft finally broke out of this range and it stuck. But then yesterday, inside day, weak start on the week. Now this morning in the pre-market, you can see that we're facing an inside day breakout of this IX10 pattern. So the day that I'm focused on right now, Friday's level, it's the 31st. Now that we're up at this level, we really don't want to see it come back inside of yesterday's level. So we can fade down in the pre-market, or we can even fade down at the open. Test Friday's close, which is also the high of yesterday, but that needs to hold. So that would actually be a nice bullish play. Good trade setup. Fade down either at the open or before the open, bounce off of that level, prove it as support, and then make the next leg up to continue this breakout. This is a bullish harami. Usually you get the downtrend, then you get the pregnant candle, and then you get the break. And that's not what we have here, right? We've got an upward move and then the pregnant candle. So it's not quite the same, right? Not exactly what we're looking for. And that matters, right? You wouldn't really want to focus on an inverse head and shoulders at the top of a range or a regular head and shoulders at the bottom of a range because it's not in the right spot for that kind of pattern. So Friday's close or Monday's high, they are basically the same thing. Use that as your line in the sand. It should not get back inside of yesterday's price action. All right, Apple continues that expansion run that it's been on. Really nice. Yesterday's Marbozu candle, just classic. Continuing the breakout this morning. So far, it's filled the gaps after Wednesday. So Wednesday's not filled, but since then, Thursday and Friday and Monday, all gaps were covered. I'd be looking for this to fill that gap. So maybe come down to where we closed yesterday, retest it, bounce off of it, and then continue the rally. Otherwise, we're looking at a little bit of a head fake here, where we gap up, trap the bulls, and then dump it down on their head. All right, so we got the dollar up this morning. Yields are coming up off of those lows, and the bonds are fading off of those highs. For this breakout to stick in the S&P and the NASDAQ, we're going to want to continue to see those bonds fade off. Now, if we look at the move that we had there yesterday, this is like a liquidity gap. And I know you don't see a gap, you see candles. But think of it as a gap that needs to be closed. The start of the gap, sometimes it can be a little tricky to pinpoint. Just think of where the violence began. So around 109.5. This is a fractional value. Everything on the futures used to be that way. They've slowly been converting everything over to ticks and decimals, but bonds are still fractional. So it can be a little screwy. Just don't let it mess with you. 109 is kind of the level you want to focus on. We want to see that gap closed, or anticipate that it's going to get closed, because it's kind of unresolved business otherwise. And this expansion in the 10-year starting to line up with this move in the S&P and in the NASDAQ. Which it looks like the move started in the NASDAQ and then bled out into the other markets. But that can't last, right? If the 10-year gets too high, it's going to separate from the indexes. So that's something to be looking for today. What'll happen is the 10-year will continue to go up and the indexes will begin to go down, or vice versa. It'll start to go down and they'll continue to go up. There is the third choice, that both of them start to go down, or well, yeah, there's no or there. If it gets, say, 3.6, if we get this breakout of yesterday's high above 3.5, maybe Friday's close, and then a big deal would be if we can get up to 3.6 and above. If we start to see the 10-year make those kind of moves, I really think it'll disconnect from the indexes. All right, we're not down to the lowest level of 2023. But we got the VIX at a pretty low level. And until this changes, I wouldn't look for the S&P and the NASDAQ to give us that topping pattern or to begin to roll over. So we can use the weekly candle, or we could just use $20. It's a nice round number, and it's the bottom of this big candle from the third week of March. So $20 line in the sand until we see the VIX get above 20. I wouldn't expect the S&P and the NASDAQ to give any sort of topping pattern or begin any sort of leg down. And that matches up with what I was reading on Spot Gamma 2. Like I said, I haven't gone through their founders notes to be able to parse it out yet. But they basically came to the conclusion that the S&P is likely to be a choppy, grindy move higher, while the NASDAQ is likely to leg up higher, and that you're better off being strategic on your stock picks rather than believing that you're going to get a broad-based rally through, all of the market. That's a pretty nice summary. So we take that and add it to this VIX concept. We need the VIX to get above $20 if we're going to see the S&P start to pull back. So here's one that we don't normally look at, and this is something kind of newer to me. SVXY. So unlike the VIX, which will move opposite of the market, this is moving with the market to a degree, right? We're not talking about lockstep, but if this is bullish, consider the market to be bullish. If this hits resistance and pulls back, expect the same thing in the marketplace. So then we can start using those same kind of levels like we do in the VIX at 20, or say the dollar, below $100. Put that same kind of line in the sand on this. If this gets below, say, $63, look for some weakness in the S&P. But if it continues to expand, then so's the S&P. All right, we got a gap close coming up on Netflix. $350.71, and this morning in the pre-market we're at 349.5 and 350. It's a really wide spread because there's not much liquidity this morning on Netflix. But after this really big run up, nice expansion off of the lows, looking to kind of maybe top out a little bit, and that would play nice with this gap close at 350.5. All right, data should be coming in here in a moment. Otherwise, keep your eye on the fact that it's likely to be, a continuation of bullishness through the rest of the week, since we're going to not be here Friday, and Friday's non-farm payrolls is the biggest one. Expect Thursday to maybe start to dry up on all of this push where everybody just kind of sits out. We're not talking about selling necessarily, just not really buying into a 3-day weekend right before non-farm payroll is a big deal. So today we're still early in the week. I'd expect, it's going to be just animal spirits and bullishness and get continuation of the play. Wednesday we should start to see everybody settling the books, and then by Thursday sitting on their hands waiting for the 3-day weekend to get over with. I was kind of expecting a little more out of this. All right, everybody, be careful, be safe, and I will see you all tomorrow.